Corporate sustainability previously existed in a fragmented web of voluntary frameworks and isolated questionnaires. These disjointed practices now collapse into a single disciplined system. The International Sustainability Standards Board has moved environmental and social reporting into the machinery of formal financial disclosure. The previous ESG model produced volume without coherence. A company might issue one document detailing its emissions and another promoting its governance, but these rarely connected with the recognized accounting amounts or the actual drivers of enterprise prospects. IFRS S1 and S2 establish a unified reporting architecture designed to convert environmental and social data into decision-useful financial intelligence. The standards achieve this by focusing exclusively on the information needs of capital providers, existing and potential investors, lenders, and creditors. To understand how this mechanism operates, we must construct it from first principles, layer by layer, starting from the ground up. Narrative sustainability claims without corresponding financial accounting lack the rigor required for modern capital markets. Because the primary users are providers of capital, their specific decision-making needs dictate exactly what information is required in the report. This creates a rigid base for the entire system: financial materiality. Information is material if its omission, misstatement, or obscuring could affect cash flows. The standard omits politically visible topics lacking financial relevance, while capturing low-probability events with severe financial effects. Once the data is filtered, it must be contained. The sustainability disclosures must use the exact same consolidated reporting boundary as the general-purpose financial statements. However, an entity's true economic exposure extends beyond the edge of its legal ownership. Therefore, management must conduct a value chain analysis, identifying risk concentrations in upstream supplier networks, logistics corridors, and downstream customer transitions. By combining a strict legal perimeter with a mandate to look beyond directly owned operations, IFRS S1 and S2 enforce the strictest reporting boundary in accounting history. The filtered data is processed through 4 core pillars. IFRS S2 applies the same architecture established by IFRS S1, beginning with governance. The standard requires documented proof of institutional control, demanding transparency on board competence, formal mandates, and the frequency of strategic reporting. It also forces the disclosure of accountability mechanisms, revealing whether and how sustainability performance metrics are tied to executive remuneration policies. The strategy pillar carries a heavy analytical burden, requiring management to explain exactly how sustainability risks alter the business model and value chain. IFRS S1 demands a transparent accounting of strategic trade-offs. The report must show the decisions made when balancing short-term margins against long-term operational resilience. When applying the IFRS S2 overlay, this section demands explicit climate transition planning, exposing the specific assumptions and dependencies driving the company's decarbonization strategy. Management must test the strategy through climate resilience assessments, utilizing rigorous scenario analysis across short, medium, and long-term planning horizons. A firm must quantitatively model its capacity to survive and adapt under adverse external conditions. Moving to the third pillar, risk management requires disclosure of the mechanical process used to identify and prioritize exposure. Integration is mandatory. Sustainability exposures must be prioritized alongside traditional enterprise risks, like cyber threats or liquidity constraints. The standard also requires full disclosure of the data inputs, parameters, and evidence quality used to build these internal risk models. Narrative claims are anchored in measurable data at the fourth pillar: metrics and targets. Under the IFRS S2 cross-industry requirements, this includes the mandatory disclosure of absolute gross greenhouse gas emissions across Scopes 1, 2, and 3. For Scope 3 value chain emissions, the framework imposes a strict hierarchy of data sourcing, requiring management to prioritize direct measurement and high-quality primary data over secondary industry averages. Beyond emissions, the framework requires capital deployment metrics. This exposes the specific amount of financing and capital expenditure directed toward the stated climate response. Without targeted metrics backed by recognized capital deployment, a sustainability strategy lacks the evidence required for investor confidence. The most demanding architectural requirement of the entire ISSB framework is connectivity of information. The data and assumptions used in the sustainability disclosures must be consistent with the assumptions used in the general-purpose financial statements. Take a practical example. A company claims in its strategy pillar that it plans a phased closure of a carbon-intensive facility due to transition risk. Under IFRS S1 and S2, this strategic claim must trigger a corresponding adjustment to the asset useful life recognized by the accountants. That claim must also be reflected in the impairment assessments and planned funding sources sitting on the balance sheet. The standards explicitly forbid isolated reputational narratives that lack a corresponding accounting footprint. Connectivity serves as an enforcement mechanism. If a stated climate risk does not exist in the financial models, it does not exist in the company's reported reality. Together, the IFRS S1 and S2 standards synchronize corporate sustainability reporting with the established rigors of the financial ledger. They create a sensitive structure where a single external shock updates the entire enterprise architecture instantly. To meet these requirements, internal silos between Treasury, Operations, and the Sustainability Office must be removed. These units must operate from a unified dataset, overseen by the Board of Directors to produce a single, coherent, general-purpose financial report. The IFRS framework translates sustainability into the language and discipline of corporate finance.